Good morning and welcome to my YouTube channel. In our last class, we discussed about how to navigate through Binance interface, majorly how to deposit, how to withdraw from Binance as well, and how to transfer funds within Binance exchange. Today, we are going to look at also that day we also look at the Binance chart interface, where we talk about the time frames, the indicators, the candlesticks, the volume traded, and so on and so forth, and then more on candlesticks. So today we are going to look at how to understand candlesticks. How to what? Understand candlesticks. In the course of this training, we'll be looking at candlestick components, candlesticks, verse, bar charts, basic candlestick patterns, bearish engulfing pattern, bullish engulfing pattern, bearish evening star, bearish araming, bullish araming, bullish araming cross, bullish araming cross, bullish rising tree, bearish falling tree, the bottom line. We all know what candlestick stands for. Our normal candlestick we use at home to light up our house. That is basically what we are going to look at today. The traders actually use candlesticks to predict the direction of the price. Now candlesticks show that emotion by eventually representing the size of price moves with different colors. Traders use the candlesticks to make trading decisions based on regular occurring patterns that help forecast the short-term direction of the price. Basically, what he's trying to say is candlesticks actually help you to understand the direction of the price. That is, you have to understand the basis of candlesticks. If you get the base of candlesticks, you are learning or you are improving your trading training. Now, key takeaways here are: the first one, the candlesticks charts are used by traders to determine possible price movement based on past patterns. What he's trying to say is there is a candlestick pattern that we have seen before now. Now, in the next year, if you see that kind of candlestick, because of the pattern you saw last time, the pattern is showing that it's coming down. So it means that if you see it again in the future, it's expected that the candlestick is also going to come down. That's what candlestick charts is telling us. Also, candlesticks are useful when trading as they show four price points. We have the opening, we have the close, we have the high, and we have the low. Throughout the period of time, the trader specifies. So, candlestick also shows the opening price, the closing price, the high, and the low. Many algorithms are based on the same price information shown in candlesticks or candlestick charts. Trading is often dedicated by emotions, which can be read in candlestick charts. All you need to know is embedded in candlesticks. So let's move on to candlestick components. When we talk about candlestick components, we are referring to the parts of candlesticks. So we have the opening, we have the high, we have the low, and we have the close price for the day. The candlestick has a wide part which is called the real body. So basically, we have 5 major components of candlesticks: the opening, the high, the low, and close, and the real body of the candlesticks. Now let's move down to see what we are referring to as component of candlesticks. This real body represents the price range between the open and close of that day's trading. When the real body is filled in or black, it means the close was lower than the open. If the real body is empty, it means the close was higher than the open. Look at the two candlesticks now. But this one is showing us black and white from the regions up there. But in normal trading, we normally see red and white. Red and green. The red now represent this black you are seeing here. The green represent the white in normal trading. So just you can try to start to change your color coding now. Majorly you will see red and green. Now the black one, let me use the black one. The black one represent the red and the white one represent the green in our normal trading when we go to our platform. So let's talk about the black. The black, it says that the opening price, look at the opening price there. It opened at that point is higher than the closing price. Look at the closing price. It's below the opening price. That is why it's black. Now, the high price is the maximum price that candlestick got to before coming down to the closing price. And the low means he has gotten to that low price as well before moving up to close at that point. So we have four major points here: the opening price, closing price, the high, and the low. Now the big thick body is called the real body. That is majorly the price. That is the price movement. Now the other one also explains the white part of it, which represents green in our trading platform. Also is telling us that the closing price, the opening price is lower than the closing price. That is why it is white or green in our normal trading platform. The bigger side is also referred to as the real body. So whenever the opening price is lower than the closing price, it means it is a bullish candlestick. And whenever the opening price higher than the closing price, it is called the bearish candlesticks. So that's why the black represent the red, bearish, and the white represent the green, bullish. Traders can alter these colors in their trading platform. Thank you. I think I love this statement. It said traders can alter these colors in their trading platform. Here we are seeing black and white, but in normal trading you will see red and green. You can decide to change your color coding. It all depends on you. So for example, a down candle is often shaded red instead of black. And up candles are often shaded green instead of white. That is said before. So let's look at candlesticks versus bar charts. Like I said earlier, we have three major types of charts in our trading platform. We have the line chart, we have the candlestick chart, and we have the bar chart. But majorly we'll be dwelling more on candlesticks because that is what our focus is. So I'm not going to talk about this bar chart. It makes sense to you. Let's move down to so this one is telling, if you see the two chart now, we have the bar chart and the candlestick chart. The same pairs of coins is being displayed here at the same time. The candlestick, the bar chart, they are of the same movement, so that the candlestick differs. That's all the difference there. My phone. Okay. In front. In front of my destiny. Front of, in front of my destiny. Sorry for that slight distraction. Now, we are going to look at basic candlestick patterns. We have different types of patterns. Like I've mentioned from the beginning, we have the bullish pattern and the bearish pattern. Candlesticks are created by up and down movements in price. While these price movements sometimes appear random, at other times they form patterns that traders use for analysis or trading purposes. There are many candlestick patterns. Here is a sampling to get you started. Like they said there are many types of candlestick patterns, but we're going to look at few of them so that as you begin to trade and analyze the market, you apply them to help you in trading. Patterns are separated into bullish and bearish. That is the only two patterns we have in this place. Bullish and what? Bearish. Bearish patterns indicate that the price is likely to rise, while bearish patterns indicate that the price is likely to fall. No pattern works all the time, as candlesticks patterns represent tendencies in price movement, not guarantees. Now, we have only two patterns, bearish and bullish. But it's telling us that none of them is actually guaranteed, in the sense that if you have seen the bullish pattern, you might feel you are good to go because it's going to go up. And when you enter the trade, it turns to bearish pattern. So it is not guaranteed. That is why after learning this candlestick pattern, we are going to look at indicators that will finalize your analysis. Now, bearish engulfing pattern. Of course, we said that bearish engulfing pattern means it's coming down. And the coin has been going up, and it has formed a pattern that is going to indicate us that there is a reversal. That means it's no longer going to go up; it's going to come down. So now a bearish engulfing pattern develops in an uptrend. You see this scenario there. It says in an uptrend. That means when it's going up. A bearish engulfing pattern cannot form when it's going down. So it is only when it's going up that a bearish engulfing pattern will form, so that it will start to come down. Now, a bearish engulfing pattern develops in an uptrend when sellers outnumbers buyers. This action is repeated by a long red body engulfing a small green body. The pattern indicates that sellers are back in control and that the price could continue to decline. Now, this is one of the pattern, bearish engulfing pattern. It's saying that it has been on uptrend trade. The first one there is bullish, and the second one is bullish. Then the next one is bullish, but the body is not much. It's saying that if the next candlestick open above the body of the body of this last one, and it closes below it, that means the body of the cover it all. That is a bearish engulfing pattern. It's just signaling that okay, the sellers are more than the buyers now. So we expected that the price will start coming down. That is what this candlestick represents. That what that candlestick represents. That the price is about to come down. So look at the next one, bullish engulfing pattern. This same pattern also formed in an in downtrend trend. That means that the coin or the candlesticks are the one forming down before this one will form. Now look at it. Look at it. There is
a bearish candle that form, it's coming down, and that bearish candle is forming again, it's coming down. Then the next one will form, but the body will not be large. After that one, a bullish candle will form below and close above the body of that one. That is a bullish engulfing candle. It's telling you that this the buyers are taking over now. That means that the price is going to go up. When buyers are buying, the price are going up. That is the meaning of this uh, candlestick pattern called the bullish engulfing pattern. Now we have a next one, bearish evening star. Bearish what? Evening star. And evening star is a topping pattern. It is identified by the last candle in the pattern, opening below the previous days. Opening below the previous day's small body. The small body can be either red or green, doesn't matter. That means that it can be black or white. It's a red or green. The last candle closes deep into the real body of the candle 2 days prior. The last candle closes deep into the real body of the candle 2 days prior. I don't know if you understand that statement. Okay, I will explain. Let me finish the reading. The pattern shows a starting of the buyers and then the sellers taking control. More selling could develop. What it means is, look at the pattern of the candlesticks. There is a bullish candlestick, another bullish candlestick. Then a candlestick open above the normally the opening price of to start from where this one closes, but discover that it went more higher to open and closes at that it closes at the closing of the last day. Look at it very well now. Now you open above. Normally, once a candlestick close, it should open immediately from that place. The next one should open immediately from that place. But look at this one now. This evening star, we call it bearish evening star. The second candlestick closes, and we expected that the next candlestick should open immediately from that same line. But no, it opened above the line and it came down and closes at that same line of the last day. That one is called evening star, not that just one. But the next open again, we open at that same place, then the real body of that coin, of that candlestick, we cover close, in fact, very deep to the last 2 days opening. That's what he said. He said in that place now, if I want to read it again, he said it is identified by last candle in the pattern opening below the previous day's small body. The last part I will read is that the last candle closes deep into the real body of the candle 2 days prior. If you see the real candle here, this very one now, the second candle there, the last candle stick closes very deep to the body of that candle. This pattern is called bearish evening star, and it's signifying that the coin has been going up. Now you want to start coming down. That's what it means. We call it bearish engulfing candle. Now we also have bearish arami. A bearish arami is a small body. Can be now it has been stated now that it must be red, completely inside the previous day's real body. This is not so much a pattern to act on, but it could be one to watch. Now, this one doesn't really mean so much, but you have to notice all of these things so that when you see them, you know how to strategize your trading. The pattern shows indecision in the market or the buyers. If the price continues higher afterward, all may still be well with the uptrend, but a down candle following this pattern indicate a further slide. Now, it said indecision in the market means that the buyers are buying. Now, that means that the coin has been going up. At that point that this candle will form, this bearish arami, I'll show you now, that it will form with a very slight rebody. We call it indecision in the market. Now, indecision because the market, the real body, as the price body, that the body that moved the price wasn't much. That means that the buyers were, contemplating of buying more or not buying again. So that is why the real body will not show. So look at the candlesticks. Here is it. The bullish are buying and buying. Now it open at that place and closes at the real body of the last day candlesticks. Let it close more. So it's telling us that this candle, it doesn't stand more per se, but you have to watch it. It's telling us that if another candlestick form and it's a downtrend candlestick, it means that the coin is going to go down. But if another coin form after this black one and the candlestick is a bullish candlestick, it means that it's going to go more up. That's what it means. Now, bullish Arami. Now look at this one. Now the same thing. Bullish Arami and bearish Arami, they are direct opposite. Now downtrend, and the Arami now form, this bullish Arami now form at that point now. Now, whenever, if the next candlestick that are going to form is bullish, it means that it's going to start going up. But if the next candlestick that are going to form after this very one now is bearish, it means that the coin will still keep on going down. So it represents indecision in the market. But you have to watch it because it will help you in trading. Now, this is one of the best candlestick you need to watch. It is called bearish Aramic cross. Also, we have bullish Aramic cross. Let's explain this one first. A bearish Aramic cross occurs in an uptrend. Like I see the candlestick there. It can never happen in a downtrend. If it's a bearish one, it must happen in a uptrend. Where an up candle is followed by a doji. The candlestick you are seeing here, the one that look like a cross here, we call it a doji in crypto or in forex trading. We call this plus candlestick doji. The section where the candlestick has eventually equal opening and close. That means that the closing price and the opening price, they are almost at the same line. It's called a doji. The doji is within the real body of the pro section. You see what he said there? He said must be within the real body of the previous section. That means the previous candlestick. If you check this one now, this cross is forming now. It formed at the real body of the last candlestick. The implication are the same as the bearish Arami. The implication is at the same as the bearish. So bearish Arami and bearish Arami cross, they have the same function in an uptrend. And dodging move stance, they present indecision in the market as well. So it's an uptrend. They know that the next candlestick did not have a real body. The closing and the opening price, they are almost the same thing. Now this one signifies a bearish trend. That means the next coin, the next candlestick that will form, if it starts to form bearish, you must know that there is a reversal of the trend. So the trend is coming down. The same thing applies to bullish Aramic cross. It only happen in a downtrend pattern. So look at this one, black means downtrend, black, three black. Then the next one is a doji. Doji means a cross. The opening price and the closing price are almost at the same point. So it does not have a real body. So if after this doji and the next available price, this or the next candlestick is now a bearish candlestick, just know that there is a reversal. But you will not use only candlestick patterns to analyze the market. That is why after studying this one now, we are going to look at the indicators. But with after this class, what we do, that I will just go to a platform and be spotting out all of these things I just showed you. Now this candlestick pattern signifies something and telling us you need to go up and come to conda. That's what next thing I will do after this class. So bullish rising trade. This pattern starts out with what is called a long white day. A long what? White day. Then on the second, third, and fourth trading section, small bodies move the price lower, but not lower than the real white body. You see what it means there? Bullish 3, bullish rising 3. So this pattern start out with what is called a long white tail. Then on the third, and the fourth trading section, small red bodies move the price lower, but they still stay within the price range of the long white body. You see, so these three bearish candlesticks now that are forming, the white one has covered the three bodies. It signifies a bullish trend. It signifies what? A bullish trend. The fifth and last day of the pattern is another long white day. It's once this candlestick is formed like this, there is every tendency that is going to continue to go up. It's going to go up. That is what it stands for. Bullish 3, bullish rising 3. If I finish this class, I'll make sure we also bearish falling 3. That is the direct opposite of this one now. Is what we're going to see below. So that means that there is a downtrend, a long downtrend candlesticks, followed by 3 uptrend one that did not cover the body. Then after the 3 other one, the next one will be another downtrend. It means that it's going down, called bearish candlesticks. Bearish rising 3. The next one is called the bottom line. The bottom line, we're going to just summarize all of this. That's what the bottom line is all about. Bottom line or take home of what we have just discovered or discussed this morning. As Japanese rice traders discovered centuries ago, investors' emotions surrounding the trading of an asset have a major impact on that asset movement. Candlestick help traders to gauge the emotions surrounding a stock or other asset, helping them make better prediction about where that stock might be headed. So that is the all about candlesticks components and a different pattern. In this class, we have looked at candlesticks and we have explained that candlestick help traders to analyze the market. It helps traders to know whether the price is going up or is going down. We also have two different candlesticks. No, they said it's not static. That means you can decide to use different colors. In this document, we saw black representing the bearish and the white representing the bullish. But in also normal trading, you can see the bearish as red color and the bullish as what? As green color. The components of candlesticks, about 5 of them: the opening, the closing, the high, the low, and the red body. So we also look at different candlestick pattern. The bearish engulfing, the bullish engulfing, ramming, and so on and so forth. So in my next video, I will go into the exchange and be spotting out these different types of candlesticks and how that will help you to analyze your market. Thank you and God bless you. And they keep talking.